This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 379 was produced on June 8th, 2023. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Bill Blain returns as this week's feature interview guest. Bill and I will discuss whether inflation is transitory, sticky, or secular, the outlook for yields and equity markets, artificial intelligence, precious metals, and much more.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, June 7th, 2023. The S&P 500 was up 200 basis points, closing at 4274. We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The U.S. dollar index down 12 basis points to 104.10. The July WTI crude oil contract up 652 basis points, closing to 72.53. We'll take a look at that chart, and Eric will have the EIA inventory data in the postgame segment. Gold down 119 basis points to 1958, remains in consolidation. Copper up 302 basis points at 375, crawling its way higher week over week. And uranium up 357 basis points to 56.55, continues to bull higher week after week. The U.S. 10-year Treasury yield up 13 basis points to 380 points. The key news to watch next week is the CPI and PPI inflation numbers and a wave of central bank meetings with the FOMC press conference, the ECB, and the Bank of Japan. This week's feature interview guest is Bill Blain. Eric, why did we get Bill back on the show this week?
Well, Patrick, as we're facing a rather perplexing macro backdrop with everybody questioning what's going to happen with inflation, rates, whether the equity market is topping out here and so forth, we've been rotating through our best macro names as our feature interview guests in recent weeks. In Bill's case, it's been way too long since we had him on, so we were overdue. He's a listener favorite, and it was time to get him on to get his perspective on this very confusing macro environment that we live in.
Well, Eric's interview with Bill Blain is coming up as MacroVoices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Bill Blain, author of Blain's Morning Porridge and strategist for Shard Capital. Bill, it's great to get you back on the show. It's been way too long. Let's dive in and start with the topic on everyone's mind, inflation and central banks. Are we really in a transitory inflation that's about to go away and be all over and done with, as so many people want to tell us?
Well, Eric, it's great to be back on. Transitory, that's a word from last year. We don't use transitory anymore. We talk about how sticky inflation is because that's what's changed. The underlying narrative surrounding inflation has gone from the central banks promising us inflation last year to the numbers now telling us that wage pressures, supply chain pressures, producers trying to put up prices because of supply chain pressures and wage demands is all contributing to a very different inflation landscape. But I don't think we can blame the central banks for getting it completely wrong, because they are getting inflation under control for the economy that we thought we had. But the problem is we have a very, very different post-COVID economy. I'm very happy to go into that in detail.
Let's go ahead and dive into that, starting with the geopolitics angle on what's different, because needless to say, it's very different. If I think about geopolitics and trade, I can make the argument that, boy, the world is really closing in. We're going to have less international trade because people don't trust each other as much anymore. Things are slowing down. But wait a minute. If I look at the numbers, trade numbers really don't look so bad. Is it just not hit yet, or am I misinterpreting what the risk is, or how should I think about this?
I think that the world likes to scare itself about geopolitics. We've kind of convinced ourselves after the shock, horror, and surprise of the Ukraine invasion over a year ago that that kind of thing is normal. But in fact, it's anything but normal. And that's why it surprised us, because we had very good intelligence it was coming. But it still caught markets by surprise. And markets always tend to overemphasize the bad news and underestimate the good news. Now, when it comes to geopolitics and the way that it's changing global trade, yes, it is, but not in the way of geopolitical conflict. What you've got to do is really go back into the early 2000s when China joined the World Trade Organization, WTO, and China started mass production and becoming the cheapest to deliver economy in the world. Now, that effectively exported deflation across the globe and especially into the West for the next 15, 20 years. And that deflation is one of the things that kept inflation so low in Europe, in the UK, and the US for so long. And then, of course, we get a change. And sorry, I should go back until 2008 when we had the global financial crisis. And then we had the additional effect of ultra low interest rates, quantitative easing, and policies that were designed to keep interest rates as low as possible, with the idea that pumping money into the economy would create borrowing that would expand businesses and create an economic boom to replace the bleak times that we thought we were going to have as a result of the global financial crisis. But of course, that's not what happened. What we actually had was massive, soar away, hidden financial asset inflation. And that happened in stock markets and bond markets. Bond prices all went shooting up because interest rates were so low, and that caused people to go on what we call yield tourism, going into equities and fueling the speculative bubble that drove tech stocks throughout the period, but also created all these crazy things like cryptocurrencies, meme stocks, and many of the stocks, the big tech stocks that are still trading with 200 times multiples today. And that inflation was hidden in financial assets right up until recently. And now, of course, we have the explosion created or triggered, not created, triggered by the energy shock in the wake of the Ukraine invasion. And that's really brought inflation to the fore within economies. Now, we're seeing different effects in every economy. The US is coping with it better because the US is a bigger, internalized economy. Europe, surprisingly, is coping quite well because it's finally getting its act together as well. And the really bad nation, of course, is my own, the United Kingdom, where we have effectively 20% food inflation and no sign that prices are going to fall. And that's something that investors really need to cope with. If food inflation is 20%, core inflation is remaining sticky around 8% in the UK, probably 4% elsewhere. That means if you're only getting 5% return from a bond yield, you're still getting very, very little.
Let's talk a little more about those consequences and implications of inflation. A lot of people are still stuck on this narrative. Look, it's all just this sort of echo boom from the COVID stimulus. the inflation's going back to 2%. It's just, you say that it was last year's word to say transitory. I think some of the central bankers are still stuck on last decade's terminology. I'm not sure. But I don't think everybody gets it that inflation's here to stay. What happens when everybody figures it out?
Well, it's creating all kinds of certainty in markets already. You've got people saying, well, why would you be a bond buyer when we still have effectively negative real interest rates? Much better to put your money into stocks. And that's one of the things that is keeping stock markets relatively stable. And yeah, I know that there are really only 7 stocks that are going through a boom time, the mega 7 tech stocks, and the rest of the market's effectively flatlining. And of course, one of the big calls everyone made earlier this year was buy fundamental value stocks. They'll be worth something. Well, you know what? They have flatlined. That's one of the effects of people trying to figure out what they should be doing about inflation in order to hedge themselves against it. Bonds just don't make a lot of sense. And if you believe inflation is going to be long-term and painful, that's going to cause all kinds of problems for the economy, not least the fact that real wages are playing catch-up, which means people have less money in their pocket, which means they're spending less, which means that corporates are making less money, therefore making them look less valuable on a normal stock market model. But of course, we don't have normal stock markets models anymore. We still have FOMO, fear of missing out on NVIDIA or whatever Tesla does next, and believing whatever you will about them. So there's all kinds of consequences and implications for the markets. In terms of the reality, though, and this is what's really important, there is really no sign to say that we're going back to the drivers that created low inflation in the noughties and the 2010s, because you don't have China being that exporter of global deflation. You have changed global supply chains, not in terms of there being conflict with China, but the fact is the Chinese economy is changing to service itself rather than the rest of the world. It's becoming a domestic consumption economy. And at the moment, one of the reasons we're seeing this slowdown in China is part of that change. And it's beginning to struggle with the same problems that Western economies struggle with in terms of property values and their banking system. So that's a big change to the drivers of global trade and supply chains, which of course is a massive influence on inflation. And if people really do believe that central banks are going to go back to the absurdly low interest rates that of the 2010s post-global financial crisis, then I think they've got to really think long and hard and say, why would they do that? The distortions that caused are things we're going to be dealing with for decades.
Let's expand on the China topic and talk about the BRICS alliance, what some people call the Global South. Seems to me like a lot of the marketplace is still kind of ignoring all of this and saying, it's just those little countries. Well, wait a minute. They represent more than half of the human beings on the planet, and they're in the process of trying to assert a new currency system, which, from the sounds of things, is exactly what I predicted they would do, which is to try to compete with the U.S. dollar as the world's global reserve currency. Now, I'm not suggesting they're about to displace or replace the U.S. dollar overnight, but it seems to me that they can make a pretty significant dent in the dollar's monopoly, if you will, over the global trade and the use of dollar-denominated reserve assets by central banks. Is this a real trend, or is it just fluff?
It's a fascinating topic to discuss, he said in a diplomatic kind of way, not wishing to tell you you're talking stuff and nonsense, Eric. But no, BRICS is a fascinating topic. And it just so happened that way back in the dim and distant times when dinosaurs still ruled the planet, I was a young financial journalist for Euromoney in the 1980s. And one of my quote gold go-to economists was a young Yorkshireman called Jim O'Neill. And he was the guy who went and coined the phrase BRICS back in the early 2000s, bringing in Brazil, Russia, India, China, and South Africa. And his argument was that as these high population countries industrialized and got richer, they would become increasingly important to the global economy. And that has really played along with the narrative that China has been developing over the last 20 years, that China is going to step up and play its rightful place in the global economy. Now, if you actually look at the BRIC economies, I think China is about 70% of their total in terms of contribution to global GDP. But they still, even though they are about, BRICS is changing, and we'll come to that in a second. But China is definitely the dominant power within it. Now, China has been trying to create its own financial and market ecosystem for decades, ever since it joined WTO. And the most obvious example of that is what we call the Belt and Road project, whereby they're building infrastructure that will now allow them to export and import all around the globe. They're building ports, they're building influence, and some of it's going okay, and a lot of it is regarded as debt capitalism, where they're forcing countries into debt to take their infrastructure. And it's a bit meh in very ways. But what we're also seeing now is BRICS becoming a second part of that. BRICS has become an actual organization. They have their own investment bank down in Shanghai, and I think they're meeting this week in South Africa, where they're going to be talking about exactly these subjects. Should they have their own equivalent of the IMF? That's very attractive to many nations who are forced to agree on economic cuts and programs with the IMF to get lending from them. And should they have their own currency to compete with the mighty dollar? Yeah, it all sounds very plausible. But again, the reality, of course, is very different. Where you've got nations like Brazil, which are, major parts of the global economy, if they were to de-dollarize, the amount of damage that would do to their economy would be humongous. Then you've got India. Now, India is growing faster than China. China has a massive demographic problem. India doesn't, unless you say a rapidly expanding young population is a demographic problem, which in many ways it is. But sometime in the next 15, 20 years, India is going to catch China up. India and China are not bosom buddies. They are not aligned with each other. Yes, they share a common interest in getting cheap Russian oil, but they are fighting on the borders up in the glaciers of the Hindu Kush, and they're not aligned. And I think Russia has really put itself, and this is going to be an interesting thing to talk about. What is the future for Russia? I mean, China is very keen to be engaged with Russia because Russia is just an enormous larder of all the raw materials and resources that China would like to get its hands on. And it's been really interesting to see some of the recent comments about parts of Siberia having been taken from China in the 18th and 19th century that are beginning to emerge. And I think China is watching with great interest as to how Russia has been performing in Ukraine. Because remember, the Russian armies, the Red Army as was, is effectively organized in exactly the same way, the same doctrines, tactical doctrines and strategic doctrines that the People's Liberation Army of China uses. And we've seen that that simply doesn't work. So I'm sure the Chinese are making a lot of noise about Taiwan, but they're now very aware that they may have to go and rethink this exactly. And that brings us back to the whole geopolitics thing. But sticking on BRICS, I think the concern that BRICS is going to come out with a complete alternative to the dollar, that's not just a few years down the road. That's longer down the road, because the dollar is freely exchangeable. It floats. Anyone can use the dollar. That is not true for renminbi. There is a very liquid dollar bond market to invest your dollars in. That is not true for the Chinese bond market. I mean, everybody talks about de-dollarization, and yes, it probably will happen. And there is a lot of truth in all the people like Ray Dalio and David Murren who say that this is a historical trend, that empires rise and then are replaced by the next one. And yeah, there is an element of that going on. But at the same time, I think would be over worrying if we think that overnight BRICS is going to become a significant force. What it is something for previously non-aligned countries to align themselves with. And that's been the really geopolitically interesting thing that's happened post the Ukraine invasion, where you've seen the oil states of the Middle East separate themselves from the Western Bloc, link themselves very closely to China, and take a non-confrontational stance with Russia because they see this as an opportunity for themselves. But even that's beginning to break down. If we take a look at the big news, the beginning of this week in early June, where we've seen the Saudis unilaterally effective cut oil production and the Russians refusing to do so. Now, the Russians are selling their oil cheap as chips, effectively, and that is a problem for the other oil-producing nations. As I said earlier, these nations are not aligned with one another's goals and objectives in the same way that the nations of the West, by that I mean including the Asian nations that are linked with the West as well. Sorry if that's all a bit rambling, but I think we shouldn't overly worry ourselves about BRICS. As long as the West continues to demonstrate that it's doing better, then it's not going to be an issue.
Now, a related concept you've written about is called virtuous sovereign trinity. What does that phrase mean, and how does it play into this whole conversation?
Right. Virtuous sovereign trinity was something that we came up with during the absolute farce that was British politics last summer. I don't know if you all remember, but it was like something out of Game of Thrones. Boris Johnson was deposed by a coup of slightly less right-wing Tory MPs in his cabinet who all resigned together, forcing Boris out, and they had an election which Rishi Sunak was comfortably expected to win as the heir anointed, even though he'd been the one that had et bruti stabbed Boris in the back. But it was won by this remarkable woman called Liz Truss, who scares a lot of people in British politics. And Liz came in, and I think she lasted, 49 days, during which time she did something that Napoleon, the Kaiser, and Hitler failed to do. She trashed the UK bond market gilts. We had an absolute collapse in the gilt market when she announced with her Chancellor a new high borrowing, uncosted, unpriced, untested budget for the nation. And overnight, the gilts market collapsed because so many investors have been investing in gilts on a levered basis, and that triggered margin calls. It crashed sterling, and the whole of the nation wobbled until she was out, and we finally got Rishi Sunak. Rishi Sunak turns out to be a very competent MP and is doing very well as Prime Minister, if only he wasn't surrounded by his own party, the Conservative Party, who are still infighting amongst themselves. But the key point about the Liz Truss debacle is what we came up with, which we very simply called the virtuous sovereign trinity. And if you look throughout history, any nation that has a stable currency, a sustainable bond market by which that country can continue to finance itself, and competent politics, there you are, your virtuous sovereign trinity of bonds, currency, and politics. If they're all working well, then generally that economy will do very well. It will create a stable platform for businesses to thrive and for effective delivery of government services. And when we saw the collapse of political competency in the UK, we very quickly saw the tumble in gilts, the end of the sustainable bond market, and the crash in sterling. Now, we've been very fortunate indeed that we've managed to recover from that, but you can apply exactly the same theory elsewhere. Let's pick another nation at random. Oh, I know what. How about the United States of America? Had we not had, I think, a very clever and non-partisan agreement between Biden and McCarthy to get a solution on the debt ceiling crisis, that would have been the kind of political incompetency that we'd seen in the UK cubed rather than just squared. It would have had all kinds of implications, and you know what, would have speeded up the de-dollarization of the global economy. So this virtuous sovereign trinity is something that it's a very simple analysis, but you can apply it to almost any nation. How smart, how clever are their politicians, and how stable are their markets? Therefore, how successful will the economy be?
What does history teach us about achieving this sovereign trinity that you're talking about? Because it seems to me that the BRICS countries clearly don't have this. In other words, if you say, well, BRICS is going to take over the world. Well, no, actually, they don't have a stable currency. And even if they did, they don't have a deep and liquid bond market that would allow you to invest or put reserve assets in that currency. It's not practical to use their currencies as reserve assets. It just doesn't work. What does it take to get from that doesn't work state to, okay, we've achieved the sovereign trinity? Because it seems to me that the BRICS would be one hell of a formidable competitor to the United States and Europe if they could achieve this status that they clearly don't have yet.
And I think that's a fascinating argument. And that's one that I think there is genuine mileage in, because if we look back a couple of centuries, the United Kingdom conquered India almost overnight in just the space of a few years in the 1740s. And that and during the first real global world war, which was 1759, between France and the UK effectively. Britain conquered India completely, effectively took the nation over. And it was able to do so because there was de facto civil war running around the Indian subcontinent. You had Muslim overlords and Hindu populations. There was all kinds of friction. Britain was able to move in. Now, at that point, the GDP of India was many times the GDP of the UK, probably many times that of Europe. And the same was true for China in the 1600s. And when you had periods of political incompetency and monetary collapse leading to civil disorder and effective civil war, these nations become very, very weak, and they were effectively the barbarians, i.e. my ancestors, went in and cleared the places out. That could happen again in the same way within Europe and the US as their time in the sun comes to an end. And as economies recover and grow, especially if they're doing so as part of a global trade organization and agreement and a world where we have free and easy global trade, which enables efficient nations with cheaper costs of production to outperform and outcompete, which is what was happening in the first 20 years of this millennium, then you're going to see these countries, especially the strong ones, especially China, which is well organized, possibly achieve that growth. Now, at the moment, we think that's stalled because of the geopolitical tension between the US and China. But if China was to get back on track, as I think it probably will, I think we'll see China eventually emerge at some stage with a much stronger economy and a much stronger currency market. The problem for China, of course, is that they got old before they really got to that rich stage. Their demographics was hopelessly compromised by the single child policies, which are now kicking in and are going to leave them struggling. I'm not so certain about India. Now, I absolutely love India. It's a fantastic place. The people are fascinating. They're brilliant, but they are the most chaotic. And you just wonder, will India ever be able to organize itself without compromising itself over its internal politics and still ongoing religious problems? But I think you're quite right to wonder that if we see maybe 20 years of global stability and growth and climate change and other issues all being successfully addressed, will we see the emergence of much stronger nations which really will challenge the Western hegemony?
Bill, let's bring this conversation to the here and now with a topic that is really on a lot of people's minds, which is artificial intelligence. I'm going to go out on a limb here and say I was wrong in 1998 when I was selling my software company, and I said there's never, ever going to be a time in history when Wall Street guys are more confused about what the hell they're buying than they were in the late 90s. I think with AI, we're setting a new record. What's going on here? Where's it headed?
Yeah, AI is the hot topic of the day in the global financial markets. Everybody wants to be in AI. I was talking to one of our investors the other day, and I was talking about something we're doing in a different sector, a private debt deal involving real assets. And she thanked me for calling up and talking about something real. She was fed up of getting phone calls from Goldman's and everybody else telling her about the new hot opportunity to invest in AI by buying massively overpriced stocks that were already up to the moon. So yeah, there is an awful lot of froth and there's a lot of bubble going on, and it's going to get worse. And here's why: because AI is not going to require loads and loads of investment to happen. I made a joke about the next tech unicorn, in fact, diamond unicorn, that's a 10 billion number, is going to be a company founded by three girls and a dog. And one of the girls will be there to tell the AI what to do, which is write its own programs and start trading with other AIs. The other girl will be there to organize the first girl's lunch and dinner schedules, and the third girl will be there to cook them all lunch and feed the dog. You really don't need that many people to make a successful AI company because we're already at the stage where programs are writing themselves. You're going to see this massive change in the middle class, professional classes about where they're going to be employed and what they're going to do. But as always happens, whenever anything new comes along, everybody jumps onto that bandwagon. And, apart from seeing potential opportunities and watching the spectacular bubbleiciousness of Nvidia stock, which in many ways is quite deserved because they build stuff that other people simply can't, that's going to enable this to happen, it's still a lot of froth. And there's also the question of what will it do to markets? And that's where I think we get to the stage where, as I wrote recently in something, I can't even remember what it was I published this in, but it was that no matter how clever, how big, and how powerful an AI is, it's never going to be able to predict the future path of markets any more clearly than a gypsy crystal ball, because you never can tell what's going to happen next because of the multiple consequences. And we're still at a stage where an average human brain like mine is enormously more complex than anything we're close to in AI. But it is something we're watching very, very closely.
I've been bouncing around from a number of topics because I wanted to give our listeners a sense of all of the fascinating things you cover in Blain's Morning Porridge. But let's bring this all together now into markets and investments. I'm guessing the 60-40 strategy is not going to cover the new world that we live in. What does? You've, between stocks, bonds, alternative investments, you've written about such esoteric things as aircraft leasing and how that fits into this economy. How should we be thinking about portfolio construction?
Yeah, I mean, look, there's you can go out into the market anytime and find hundreds of analysts who are predicting the imminent end of the world on inflation, on geopolitics, that WEF is about to destroy the global economy. That's not the kind of thing I do. I mean, I really believe things are never as bad as we fear they're going to be. Unfortunately, they're never as good as we hope they're going to be. So what you got to do is think about when markets are as uncertain as they are, and that doesn't mean end of the world stuff. It just means we don't know whether they're going to go up or down. You've got to really be quite defensive, and you've got to look at things that are going to preserve your capital, but also give you some kind of return. Yes, you can put some money into speculative plays. Things like Nvidia was, yeah, if you called that one right, well done. But if you're going to put your money into bonds just now, I think you got to be very concerned because I have a feeling that interest rates are continuing to rise until central bankers really think they've got this under control. that is going to spell all the risks of a soft landing and what that does to corporate earnings. So one of the areas that I tend to focus most of my time now is what we call alternative assets. Now, alternatives can frankly mean whatever you want it to mean. I take it to mean any kind of private, unlisted, off the wall, different kind of assets. So we look at it could be anything from transatlantic fiber optics, about the rental incomes that they earn. And one of the ones that we're looking very closely at is aviation finance, because we think there just happens to be a fantastic opportunity in aviation at the moment. And the reason for that is analyzing what the economy is doing and what's happening with the airline industries and what's happening with the plane makers, effectively Boeing and Airbus. And you could do the same thing with any kind of scenario. It doesn't have to be aircraft, but what you can do is find opportunities that are going to achieve better returns and better yields than risking negative real yields from low yielding government bond markets, or running the risk that you invest in corporate bonds and the corporates turn into junk. What we're looking for in alternative debt strategies is something where the risks are really well mitigated and you know that you're going to get income produced on a regular basis. So very quickly, with the aviation deal that we're talking about, we've realized that Boeing and Airbus are failing to deliver as many aircraft as they hope to do. These are the new aircraft with green engines. And the reasons for that are multiple. Boeing's got appalling industrial relations. Airbus is frankly short of the engineers it needs to build aircraft. And the engine makers who supply both of them are struggling to make these new engines as efficient as they should be. As a result, instead of delivering 60 new Boeing Maxes a month, they're only delivering 30. That means airlines are going to have to wait 5 or 6 years till they get new aircraft. And as flights reopen post-COVID, there's a dramatic shortage of aircraft that can be used for routes in the market. The result is that the value of second-hand aircraft, mid-lifes as we call them, between 8 and 15 years, has started to rise. So one of the deals that we're looking at is to put together an investment package based on the rentals that these aircraft are going to earn and the fact that they're going to remain valuable for longer. And that will produce returns in double digits for taking a comparatively low risk. And when you've got inflation creating negative real yields in government bond markets, you need to find alternative sources of income. And at the moment, I just think that equities are too uncertain. And as I said earlier, bond markets are looking, well, flatline.
Where do commodities fit into the whole story?
Well, gold's always the one to think about first. And the more uncertain the world is, the more gold goes up. But remember, gold, as somebody once told me, is just physical cryptocurrency. You can't really do much with it. You can't go and buy anything with it. And on its own, it's not got much utility, except in a way that crypto never will have. It is a genuine store of value. But as global uncertainty goes down, which I think it's going to do, as China holds off from creating tension in Taiwan and looks to re-engage to boost its economy, then I think you're going to see gold start to become slightly less interesting. Then you've got people looking at, if we're going to have a global recovery, then you've got to play copper because, copper is electric. If you don't have copper, you don't have electric. So that's a game to play. I am more concerned about some of the more esoteric things, and the one there, of course, is lithium, because there seems to be something of a backlash now developing against electric vehicles. People are beginning to understand all the inherent difficulties that they create, and I'm just wondering if there's going to be a bit of blowback on that. That said, lithium is a scarce resource, and people are able to produce it and able to put batteries together. And that looks a very good trade. The other one, of course, that everyone watches is oil. Now, energy was the thing that we thought was going to win Russia the war in Ukraine. Hasn't turned out to be the case at all. Energy prices have very quickly come back down. And that's really because of how quickly we were able to build new energy chains. Germany, remarkably, was able to start importing gas within 6 months, when initially we thought it might take 5 years. So there are times with a little bit of effort, some of the problems in energy security can be pretty quickly resolved.
Bill, as a reader of your Morning Porridge letter, I know you cover lots and lots of topics. Give us a sense of some of the more esoteric things that are on the margin that you write about.
Yeah, thanks for that. That's a great question. I mean, I love writing my Morning Porridge. I get up early every morning to write it because it means I've got something to talk to my clients about all day. But the thing is, it gets dead boring just writing about inflation or what central banks are doing, or that bond yields went up and stock markets went down. So I try and find stuff that's going to be slightly interesting and will maybe add a little bit of value to people's days. But there are some days when I just go off on a complete rant, like, funnily enough, this morning, because one of my equity traders he was over the moon with joy because he was looking at this bull market in tech stocks and, good employment data from the States and fantastic numbers coming out in inflation, which actually scared me because I think they confirmed my sticky inflation theory. And then he said, and to cap it all, Apple's about to announce a fantastic new product, virtual reality headset. So I thought, yeah, really? Because that's been really successful for Meta and for Microsoft and Google and even Sony. They've all introduced headsets, and apart from some hard-line super nerds wearing nerd helmets, they really haven't caught on for much. So I did a little bit digging into the Apple Vision Pro, as it's called. It will set you back $3,500. And I'm still not exactly sure what it's going to let you do. But according to all the fanboys and girls producing videos about how marvelous it was, it will change your perception of everything. I just don't see how. What I've been waiting for my whole life is a pair of glasses. I now, as I get older, I have to wear glasses. And I would love to wear glasses that look like a normal pair of glasses, but were flashing up information, telling me what's really going on all around the time. Now, that might be quite difficult to cope with because my brain's bandwidth is not that wide. So will I be able to cope with a constant stream of data in front of my eyes while trying to drink a cup of coffee and talk to my wife about what I'm supposed to be doing? I suspect it will all lead to information overload. But the key thing about this new Vision Pro that Apple has introduced is this is really one of the first big projects that Tim Cook has introduced. Now, he's a marketing genius because what he did was turn the innovation years of Steve Jobs and the design of Johnny Ives into really marketable stuff. And that's what's made Apple successful. They sell loads of very, very, very expensive, bright, shiny stuff. Yeah, I know most of it's different colors now, but I still think of it as bright, shiny white stuff. But the thing is, the Apple stores are looking increasingly jaded. There's not been anything really new for a long time, just upgrades. Innovation seems to have gone. And this new Vision Pro just looks like a product for the sake of a product, and I really don't see the demand. And then, as I was reading about it, I discovered it has an attached battery pack. Come on, nothing has an attached battery pack in 2023. That is so old school. Who's going to accept that? So I have a feeling that this Vision Pro is not going to be a massive success. Maybe it will lead to a successor thing, and maybe I'll eventually get my smart glasses. But while it's not going to spell disaster for Apple, I think it will beg some questions about the direction that Tim Cook's been taking the company. And, there's never been that much criticality about what Apple's been doing with itself all these years. It's got a fantastic war chest. It makes loads and loads of money. But what's it actually adding anymore? It sold 200 million smartphones, the iPhones, but where's the next big thing going to come? So that's just as an example of the kind of things that I think about and write about every morning in the Morning Porridge. And if anyone wants to try it, get in touch and I'll let you try a subscription.
Well, Bill, I can't thank you enough for a terrific interview. Before I let you go, though, please do tell our listeners where they can get the Morning Porridge, how they can subscribe, and what they can expect to find when they do.
Okay, well, I wish I'd written myself a little jingle to go something like www.morningporridge.com, something along these lines. Yes, you can find me on www.morningporridge.com. And you can subscribe. There is a bronze free subscription where you get 3 free copies a month. You get an article 3 or 4 times a week, and you have access to my my whole back catalogue of articles going back for years. Plus, you can call me anytime and ask me what you think if you're a Porridge subscriber. But do mind that I also have a day job working for Shard Capital.
Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, great interview with Bill Blain. Now let's get to that chart deck. Listeners, you're going to find the download link for today's post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Bill's picture saying, looking for the downloads. Now, Eric, let's cover crude oil, starting with the EIA inventory.
EIA printed a drawdown of 451,000 barrels. That was really 2.3 million barrels if you also consider the 1.9 million barrels that was pilfered out of the Strategic Petroleum Reserve this week. That was the 10th weekly drawdown from the SPR at the very time that we were originally promised that the Biden administration would be refilling the SPR. Cushing, Oklahoma, building 1.8 million barrels. The big builds on the board were in finished products. Gasoline building 2.7 million barrels. Distillates building a gigantic 5.1 million barrels. U.S. production ticking up 200,000 barrels to 12.4 million barrels per day. That is a new post-COVID high, and hopefully it's the beginning of a resumption in a recovery all the way back up to our previous record of 13.3 million barrels set prior to the COVID pandemic. We've been wondering whether or not it's possible to get back to that production level. Some people have said it's not. We're finally starting to see signs that that plateau that was forming around 12.3 million barrels is starting to break to the upside. OPEC Plus met this past weekend, announced that they were going to hold their cuts while Saudi Arabia voluntarily cut an additional 1 million barrels per day. So far, just for July. They're not telling what they're going to do, whether they're going to extend it for another month beyond that. The other big outcome from the OPEC meeting was that the United Arab Emirates got a bigger allocation. I think that's going to settle down what may have been some restless nerves on the part of the United Arab Emirates. Maybe they were considering breaking away from OPEC because they thought they weren't being treated fairly. Sounds like they've reached a resolution where everybody's happy again, and UAE is going to have a bigger allocation inside of OPEC. And of course, that will give the United Arab Emirates a bigger allocation, which represents, in effect, a concession from Saudi Arabia. I applaud OPEC and Saudi Arabia for rebuilding spare capacity. We very much need to rebuild spare capacity, and cutting for that reason makes perfect sense to me. But I absolutely do not applaud the tactics that they're using of trying to trick the market. They're, making a press conference announcement saying one thing, trying to fake out traders, and then doing something else at their meeting. Those mixed signals are not helping anything. And frankly, the technique of blaming speculators for volatility in the markets is something that used to be only U.S. government officials were so ignorant as to do publicly, despite the fact that all the research, as well as their own FINRA Series 65 exam question, says the exact opposite is true. Speculators absorb volatility, not cause volatility, and they help keep markets stable and liquid. It's a pity to see OPEC following suit with the ignorance of U.S. politicians and blaming speculators for market conditions, but that seems to be what they're doing. The grown-ups in the room know that the market doesn't function the way that some of the OPEC ministers have been alluding in their recent statements. The rapid retracement of the OPEC pop, that is the gap up open that we saw after that surprise OPEC meeting, it's already retraced all the way back down, well below where it was before the OPEC meeting, and that signals that the market is more concerned about demand than supply.
Eric, I wanted to talk about the technicals. On page 2, we have that chart of oil. And what I highlighted here was the high volume node zones between the $75 to $83 area on crude oil. And that I consider that to be a fair market value zone. And what we see here is that crude oil continues to consolidate below that area. The 200-day moving average is descending down into that $80 area as well. And the way that I'm looking at this is that the bears remain, at least on the short term, in control of this price action with us below the $75 level. The first thing that we'll be looking for is at some point the neutralization of this one-year downtrend with a break back up into that 75 to 80 trade range and potentially set up for a trend shift. But right now, the downtrend of lower highs and lower lows remains intact, and we'll see whether the bulls can neutralize this with a break above 75. Nonetheless, Eric, what are you thinking here about equities?
For at least a couple of months now, I've been predicting a rally to 4309 on the S&P. That's the 61.8% Fibonacci retracement of the overall bear market. And I'm going to count this week's test of 4306. That's 3 points shy of my target. I'm going to count that as a hit since I was filled on my order to short the market just a few points below that technical level. For the record, what I actually sold was the September contract at 4345, taking advantage of contango in the market in order to avoid the expiring contract and short a later expiry from a higher location. Now the question is whether the bear market rally is really going to end as I predicted it would here at the 61.8% fib level, or if it's just going to continue higher. Technical analysis lore says that if it goes much past 61.8%, it's probably going all the way to 100%, meaning new all-time highs. So right now is the time to watch this market and see whether or not we break out above or reject back down below this key resistance level at 4309 on the S&P futures chart. What happens there at 4309 should be the tell for the next leg.
Yeah, Eric, I agree with the overall assessment. There's that big key Fibonacci zone right above at this 4309, and it is certainly a point of high interest. But what I want to focus on is what was actually happening in all of the indices throughout the week. On page 4, I have the NASDAQ, and what we basically saw was a 175 basis point down day on Wednesday that reversed off of the highs. But really, the Russell and even the equal weight indexes have been doing incredibly well in that same window. So on page 5, I have the 1 week index performance, and you can see here that the NASDAQ is for the week been relatively flat. S&P 500 up 200 basis points. But what you can see here is that the equal weight S&P was up 460 basis points, while the Russell was up an extraordinary 881 basis points. The point being here that we've seen a rotation back into these small caps and back into a broader part of the market. And we're seeing a little bit of rotation out of the NASDAQ. And the question I'm trying to answer here is this a new trend? Are we going to see more of this in the weeks to come? Or was this just simply an incredibly stretched situation? And this is all big, mean reverting, quick little moves. On page 6, I have that New York Stock Exchange percentage of stocks above their 50-day moving average. And what we were highlighting weeks ago was that the breadth of the market was just so weak. But what really has happened in this past week was an extraordinary return of breadth. We went from 38% to 68%, almost a doubling of the number of stocks above their 50-day moving averages in just a week. Now, we're not in any overbought territory. Typically, this gets overbought in the 80-plus area, but it is certainly just a really interesting observation because we haven't seen this type of index action for many months. It's really just been that FANG and tech name rally that's been running up until this point. Well, moving on here, Eric, to page 7, I have the U.S. dollar index, and we have that trade range very clearly defined. I remain in the camp that this trade range will remain dominant going into the summer until we finally see some sort of a risk-off impulse that could potentially drive a short-term advance out of this trade range to the upside of the U.S. dollar index, but that's not likely in this current market condition. One way or another, what I'll be watching is whether or not we fail along the upper boundary and then trade right back to the bottom end of the range. Certainly areas I'm watching are down in the 103 or 102.5 area at the midpoints of the middle of this trade range. What are you thinking here on the dollar?
Well, we were consolidating along at the bottom of the wider long-term consolidation range between 100 and 105. Well, we had a nice rally, and now we're consolidating along again near the top of that longer time frame consolidation range. That could mean that the market is running out of steam and about to roll back down toward the low end of the range around 101, or it could mean that the market is just coiling up for a breakout above 105.5. That's the key resistance level, which is still well above the market, and that's the level to watch for an indication of where the next leg will come.
Finally, I wanted to just touch on the gold. What are you thinking here, Eric?
Well, after testing all-time highs, we came all the way back down to test key support at the 100-day moving average. That's now 1948 on the August delivery contract. We had a nice rally off of that level up to test the short-term moving averages, getting almost back to 2,000, and now we're back down to retest support at 1948. If it doesn't hold, it could be a quick ride down, another $100 to the downside, as the weak hands get shaken out if and when support breaks at 1948. So watch out below if we break below 1948.
Yeah, when looking at that gold chart, we continue to see actually failed rally attempts. So during this period where the U.S. dollar has just been stalling, there's been every opportunity for gold to get a little bit of a kick back north of 2,000. The levels I'm watching for the bulls to beat is this 2,000 to 2,025 area up above. That would really signify that they're going to take another stab at the highs and or even potentially take it to all-time new highs. But every day that passes that we're sitting below this 2,000 level increases the likelihood that this is just a consolidation at a midpoint, and one more quick washout to the downside, like you're suggesting, is potentially on the table. I would still view gold overall very bullish, and so if for whatever reason there was a quick dip down towards 1,800, I would view that as a compelling buy on dip opportunity. But on the short term, we're watching whether this 2,000 level continues to reject all gold advances and whether or not there's one more leg coming.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, the chart deck we just discussed here in the postgame, and a number of links to articles that we found interesting. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter at Eric S. Townsend. That's Eric spelled with a K. And follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.